Okay, so welcome everybody again. Another Sunday session here. It'll be very quick here. We have the Petrotel meeting in about an hour, so it will definitely be wrapped up till then. I wanted to host this session today. I've been getting a lot of questions on why I don't go into the depth of options and the implied volatility and the Greek letters and whatnot. So I just thought, look, the way I look at my options, and I'm very new to options, only about 3 months in, three to 6 months in now, that I treat them like equities. I look at what the share price will be in my projections, and I look at the macro, and if it gets there, this is what the option will be. And we just kind of go from there. So I'm going to share 4 of the options that I've bought and sold so far, and then 8 that are currently in my portfolio, and my reasoning for each, kind of what I'm seeing on them. I want to say a couple things here to start. I am not an investment advisor, so please, if you're watching this, take that into account. Please do your own due diligence and your own risk tolerance. Mic on. Just give me a sec here. I got lots of people with the mic on. Okay. So yeah, I'm not an investment advisor. Please do your own due diligence, your risk tolerance. Options are very volatile. You can lose a lot of money if you don't understand what you're doing, and they can basically go to zero in a short period of time. So please be careful. This is me sharing my strategy, what I look at, and I'm always open for questions. My email and my phone number is on the website, so feel free to contact me. And same with the Twitter Spaces, we're on there pretty often. So I think there's lots of opportunity for that. My portfolio is fully transparent on the website, so you can have a look at the options that I will talk about today and my positioning in them on the website. And yeah, we'll get started since we're short on time here. I do have a seminar on intro to call options and then intro to put options, also recorded on the website or on the YouTube channel. Have a look there, and that's probably where a lot of the questions are coming from, because I don't talk about implied volatility and I don't talk about some of the other things there. So maybe that's what's causing some of the confusion, but we'll get started here. So the first option / warrant I ever bought, my first exposure to this sort of leveraged equity, I guess, / option was with the Pipestone warrants. So Pipestone Energy, which is a producer in the Montney, had these warrants out that were expiring in middle of June of 2021 at a $3 strike for them. And you could buy the warrants for half a cent, and you needed 10 of these to buy 1 share. So basically you were buying a share for $3.05 was kind of the implied premium you were paying. And I found these just exceptional, because if the COVID crisis had cleared up a little bit earlier and the world opened up, Pipestone is a name that, you know, right now is trading at about $5 or $6. So these options would have been like a 30 to 60 bagger on these options if we were a year earlier, but it just didn't happen. So my options went to zero, or my warrants went to zero, which again highlights the risk with these options, where if your timing is just a little bit off, they will go to zero if they expire. So keep that in mind. Some of the statistics around this, I bought them in February of 2021. So I gave myself about 3 to 4 months there. You know, oil prices were rising in early 21. The equities were looking really good. Some of them had doubled in 2 to 3 weeks. So I thought, look, this is a bet worth taking, and it didn't pan out, but it kind of gave me that humbling that I required right off the bat. So the premium that I paid on these was between 76 and 136% to the share price. So very, very risky buys. The stock went up 28 to 72%, depending on which purchase, because I bought them in 2 different blocks. And the warrants, unfortunately, were negative 100%. So therein lies the big risk that I'm talking about. And for you to please understand what you're doing with them, the dollar amount was not huge, but at the time, I mean, this capital could have gone a long ways to where we are today, based on the share prices, how they've moved since February 2021. The next one I'll talk about here, which is a win for me, was the first options I ever bought. I had a good chat with one of my good friends in kind of late October, early November. He said, look, these options are trading at very, very good premiums, and some of these companies are going to announce incredible Q3 results. So why don't you have a look at them? And I always hated options because I knew that a person could get in a lot of trouble with these options. You could get cocky, you could play your risk a little too much and lose a bunch of money. But I spent about a whole week kind of doing a really deep dive on these premiums, what I was looking for. I built those 2 calculators in a way. The 2 call option calculators I have on the website. I built a cruder version of them, no pun intended, and kind of ran a lot of numbers. And I came to the conclusion that the risk reward here was worth it. If I'm going to be on margin anyways on my equities, I think I can put a little bit of option exposure in there. So I bought these options about 2 weeks before the Q3 results. And at the time, Cenovus was about $11.73. I bought the $11 strike just so, a little bit safer play, because even if Cenovus stayed where it is, I still kind of did not go fully out. I would have still lost only 30 to 40%. And the math on that is a little complicated, but it's just normal option math. I paid $1.13 for him, and if Cenovus stayed flat for the month, I still would have got 73 cents back. So I would only lose about 30 to 40% on that. And look at the premiums. At the time, you only had to pay like a 3% premium on these options for 1 month expiry. Back then, I think people were not fully confident with these things in oil equities. So, I was able to buy this at a really good premium. And in the 15 days that I held this option, the stock went up 12% and the option went up 116%. They released exceptional Q3 results. As you know, Cenovus, I believe, announced a share buyback, and I believe they also had a dividend increase. So, it just couldn't have worked out any better. And eventually I sold this option before expiry, about 2 weeks before expiry. And I was happy with that and feeling pretty good on that. But the way I treated this option specifically was straight an earnings play. I thought, look, Cenovus has been lagging. The oil prices are going up. They're going to report a banging quarter here, share buybacks maybe, and a dividend, and it all kind of panned out as such. So I think this is another strategy that I'm looking for the Q4 results. And I didn't end up buying anything, and probably a good thing, because none of them actually panned out how I thought they would. But looking into Q1, I think there's a lot more clarity as to what's going to happen here. So we will maybe have to look at them depending on the premiums once again, how things go. But this is kind of the one strategy that I like. Play the options with the big news releases that some of these companies are putting out. We saw Baytex and Whitecap put out some amazing news releases, and the stock jumped 12 to 14% the day after, which is what you want in options. The next one here that I lost money on was the same option, the November 21st or the November 2021 Cenovus option, except I went a little bit further up the risk curve, and I saw these $13 strikes available for 10 cents. So I paid the 10 cents and then the commission on top of that, and ended up losing it all. Cenovus actually went down in the next 5 days after I bought this option, and the stock was down 3%, but the option was of course down 100%. And therein once again lies the risk of these options. So please be careful again. have a look at the call options video and check out. There's a lot of resources online on options. So, please do your due diligence. I cannot stress that enough. There's a lot of questions here, so I'm just going to wait until I'm done, and then I can go through them as many as possible before the PetroTal session begins. The most recent one that I had here, which I sold, was this. Again, it's Cenovus again. I love Cenovus options because it just has a slow grind up, which gives you the extra torque you want on your equity without having this downside risk on them. So as much as I talk negatively about Cenovus, I think they've done a good job with this slow and steady rise up in the share price over the last 6 months. I mean, it's just slowly up and up and up. So looking great. And this one was a February 2022 option. It expired on, I believe, the 21st, if I'm not mistaken. And I bought it just before the new year. Cenovus was at 12 bucks, and I thought, wow, this is great. The oil prices had started rising. The equities had started moving. Equities like Surge and whatnot had started to go up, and I thought, okay, there might be a new wave of buying coming in, especially with the new year. The fund managers no longer have to show that they had oil exposure in 2021, so they could go up from there. And it really worked out perfectly. I paid an 8% premium, which was again fantastic for late December. The stock ended up going 26% higher in 42 days, but the option went up 176%. So gave me a 7x exposure there, leverage, which I mean really couldn't have gone any better. Even with the results not being good, the Q4 results not being that great, I mean, I still ended up really well. And if the Q4 results had been great, I mean, this could have easily been a 4 to 5x play, but it just didn't pan out like that. So that's just how it is. But again, this shows you the upside leverage you can have. A 7x on the stock move. There's a question here. What was the reason for not selling the option before it goes to zero? So that option was so far out of the money that there was no bid. Like you couldn't even sell it at zero because it was like 60 to 70 cents out of the money with only 1 or 2 days left. So the time premium didn't make up for how far out of the money it was at the time. There's a question here on 350 swinging for the fences. I think that's referring to the 350 options or call options that I have. And yeah, I really was swinging for the fences on that one. And again, it slowed me down a lot. It gave me the humbling I required because I realized, look, when you lose all your capital on a trade, it's done. You really can't get that capital back to invest into the market. So for me to go for these home run, like not even home run plays, like this is like trying to hit a grand slam every time you're at bat, which doesn't really make sense. So I said, okay, I can make money on options if I play them properly, if I really think about them and cool my head and not go for these, YOLO plays and whatnot, like 3 days before expiry or five days before expiry. And it's worked out really great so far. So I would definitely say that, don't treat options as if they're your like lottery ticket or your slot machine. If used properly and thought about, and you believe in the underlying, you can really make a lot of money and leverage your capital, which is always seems to be in limited supply these days. There just is not enough money to invest in these oil and gas equities. So there's a question here. Do you stick to using just long calls? So yeah, I've only ever bought long calls. I like the selling the puts options if I don't have capital and I sell these long dated puts. I think I can get some income on the side, but I haven't got to that. I just don't think it's as torquey as these long calls, and I don't use any multi-leg strategies. But Hyper, if you know more about these, please shoot me a DM or an email. I want to know more. I don't think I'll ever get to them, but it's just good to know all these things. there's somebody else that messaged me something, this super complicated strategy about you can get margin on your options that are in the money. And I just got to thinking like, holy, that's just another level of crazy. But you're buying insurance against your option that's already in the money. And I just got thinking like, how many things are people been doing like that I have no idea about, because I'm just 3 or 4 months into this, and I treat them like equities. Again, I don't treat them like buying all these option spreads and complicated strategies, because to me it's just an equity that just trades a little differently on it, on the underlying. But so okay, I guess I'll answer some of these questions here. So some of these options are illiquid. You're correct. Yes. What I find, again, and this is very common, it seems like, on these Canadian equities, even on the US option side, is the number of options for sale that it shows. There's much more than that actually for sale. And when I want to buy a certain kind of volume of them, I just put in the order kind of between the bid and the ask, and they usually get filled right away. So I think there's more liquidity than the bid ask spread or the volume or the open interest sometimes tells you, in a way. Yeah, so there's another comment here that the implied volatility gets crushed. So again, what I'm trying to say is you're exactly right. And that's why I don't buy these short dated options anymore. If I want to play in earnings, I will buy the option like well before the earnings. So I'm not concerned with this big volatility changes and whatnot, and I can just ignore it completely for all intents and purposes. Okay. There's some other questions I missed, but I'll get going here. What's your take on buying US oil stock options? I don't believe in US equities, so therefore I won't buy US options, because again, if I won't buy the underlying equity, I'm not going to buy the option associated with it. Okay, so we'll get to the options that I currently hold and what I'm doing with them. So this is another Cenovus option. I love these Cenovus options. Again, this is an April option, US $10. I bought it when it was well in the money already, so very low risk, because I mean, when I bought it, Cenovus was already at 11.81, so I was already buying something that was $2 in the money almost. I paid a $7 premium, and the stock's up 36%. The option's up 128%. So I still got quite a bit of torque on it. Obviously not as much because I bought such an in the money option. But you know what? I can buy these options all day long and sleep well at night, because the chance of Cenovus falling 15% in the next 6 months from October with my macro outlook, the chance of that was almost zero. And I thought, look, I sold about 25% of my Cenovus position. I sold the equity and I got into these options, which gave me the same upside with almost no downside. So really, really great time. Like October, November, December last year was a great time to buy options. And partly why I say these days I'm not finding the same kind of risk reward anymore is because it was such a great time that you could buy these for almost zero premium and get a 2 to 3 to 4x leverage on your equity positions if you were to buy equities instead. Okay. The next one I have is the Cenovus June option. So this one is more playing the Q1 earnings. Again, I don't buy them just before earnings. I buy them months before the earnings, so that I don't have to even look at the implied volatility. It doesn't matter, because it's going to be inconsequential to what happens when you buy them so far early. This one I actually bought out of the money option. So I paid about a 19% premium on it. It's a June 2022 US $13 call. And I paid the 19% premium on it. The stock's up 32%, but the option is up 125%. So again, I got a 4x on it. And the best part is because I bought an out of the money option, now if Cenovus goes up another 30%, let's say, my option will go up like 6 to 7x that, because it was so far out of the money when I bought it, and I bought it for so cheap, that the torque keeps going up. The more the equity comes into the money and then keeps going up, the torque just keeps rising. So so I love these ones right now. I mean, they're not as safe as the other ones, but I bought them in the end of December, and I had 6 months to play with, which I thought was long enough time for this oil macro to play out, and it's played out exactly as I expected. The oil price maybe is even higher than I expected. So looking great so far. So there's a comment here on Cenovus. So Conoco's plan is to sell all their shares by March 31st. So at that point, the selling pressure ends if they go ahead with that. Also, the contingent payment ends on May 17th, which is why I love these June options, because I think once the contingent payment ends, there's a step change in the cash flow going forward. Cenovus has to pay over $300 million in Q1 for this contingent payments. So it does take a big hit on the overall cash flow and free cash flow. And once that's done, I get about a month after that, I get the summer driving season, I get the international flights resumption, and you know, this option I think is going to be just a banger. It's going to pan out really, really well, and I got it at a really good price. So yeah, that's one thing I will say. If you want to play earnings, try and buy the option a couple months before. Don't wait till the last minute, because there's just too much premium you're going to have to pay on it, because everyone else is thinking the same thing. So just keep that in mind. You can put the money up front a couple months before, and then you're just laughing your way to the bank if the earnings are good. And you know, I showed in the last option the earnings were bad, and I still got a 7x torque on the equity. So you know, you give yourself this thing where you win either way. If the share price continues to go up into that earnings, basically no matter what happens, you're still winning, and you get this free upside in case the earnings are better, or they announce a dividend, or you know, whatnot, etc. Okay, so when Cenovus bought the ConocoPhillips assets, they had a 5-year contingent payment where if the price of WCS was over $52 a barrel Canadian, Cenovus would pay $6 million for every dollar above that for the quarter that it averaged. And that contingent payment, because the deal was made on May 17th, 2017, so it's a 5-year payment. So May 17th, 2022, it ends. And Cenovus is not liable to pay these payments anymore. So you add about, at today's pricing, you add about $400 to $500 million a quarter that they're going to save on these payments. So you know, that's about $2 billion a year. You put a 6 multiple on that. You know, that's $6 in share price right there. So you know, think about these things. I love these stocks with catalysts where they have poor hedging or they have some sort of payment that ends. You can get an incredible torque on them going into these hedges rolling off or these payments ending. So keep that in mind. You know, I've talked a lot in the past about Surge, Arc Resources, and Spartan Delta being in a similar position, where July 1st is a big day for them, where a lot of hedges roll off and they get exposed to this upside torque. No recommendation. They are my holdings. I have big positions in all three now. So yeah, that's just how it is. Okay, what's the other question here? Yeah, okay. Okay, so Crescent Point, amazing. Whoever sold these calls, I apologize for buying so many off you. I have 600 contracts of these CPG options, and just amazing. Like, Crescent Point was lagging for so long because Shell kept dumping shares from their acquisition of the Kaybob Duvernay from Shell. And I first bought these in October. then November, and then loaded the boat up in December. When Crescent Point fell in December for no reason, it fell 20% that month. I just loaded up the truck. I said, look, this is amazing. I'm just going to go all in here. Not all in, but a significant portion of my portfolio in there. And it's just been fantastic. The stock is up 56% since December 23rd. As many of you know, it's really rebounded. The share buyback has helped a lot. And the option is up 327%. The ones I bought in December, the ones I bought in October are up 167%. And the great thing about this one is now that it's in the money, if CPG goes up $1, let's say, which is only 15% on the stock, the option goes up about 150% from what I bought it at. So this is a great part about buying options early on, is that if you buy them slightly out of the money and they go in the money, the torque you have is just insane on them. And I have till 14th of April. So I think I'm gonna wait for their share buyback to kind of kick in and really start taking these stocks in. Their Kebab Duvernay, I mean, they just released exceptional results, and they're getting $150 a barrel on this light oil today. It really doesn't get any better than that. So I think I think this is one that I was really happy with, and it's made me a lot of money. And you know what? It's one that the stars didn't even have to line up. It's just that the equity was so oversold due to this Shell dumping their shares that you were able to buy these options for really good pricing and go from there. So that's the other thing I would say, keep in mind, if you can identify stocks that have these inflection points or step changes where somebody's dumping shares, you know, ARC Resources is one that for some reason just does not move. Meg Energy, another one. You can get really good deals on them because once the selling pressure stops and the buying pressure goes up with the share buybacks and the dividend yields getting increased, the options can just give you so much torque. It's pretty insane how torquey they can get in that kind of situation. So there's a question here. I always sell my options. I never exercise them. So you're right. I would usually take a profit and then just sell the shares whenever I feel like, or sell the options whenever I feel like the share price is kind of plateaued or is going to start consolidating in a way. I would just sell the options. I've never exercised any of my options ever. Suncor, a stock that gets a lot of hate for not moving and not doing the right things. So you know what? Buy options on it. Perfect. You know, you don't get the dividend, correct? But you get so much leverage on the underlying, which has very little downside risk. You know, Suncor does not drop. Same with Cenovus. They just don't drop more than 5-7%. They're steady eddies. As soon as they drop, people are buying the dip. So the downside risk is very low, and they just are on the slow grind up. So these are June 2022, $25 US options. I bought them in October again. I had to pay 17% premium back then, but look at this. The stock is up 36% in that time, and the options are up 214%. So, you know, about a 6 to 7x on the equity. So again, find stocks that are slowly grinding up. You know, don't get frustrated with them not going up or announcing these big things. Buy options on them. Buy slightly out of the money options on them, and you get a 7x torque on them. You know, with very little downside risk. So, you know, again, not a recommendation. Just what I see, just what I've seen. The different strategies that are still available today with less upside torque, but the downside is much lower because the equities are so low already compared to what the oil price and the free cash flow yields and the cash flows are at. And, you know, there's a lot of people also waiting to buy the dip. I can tell you that anecdotally. I can tell you that in reality, like these stocks have not dropped since November 26th when we had that Black Friday issue. these stocks have not dropped more than 5-7%, no matter what the oil price is doing. So they're really holding in strong, and which is great for us option holders. I also bought these options because I thought they gave me a lot of long-term potential. They're the Suncor January 2024 US dollar 20 options. So I went way out in time and I bought them in the money because look, this is basically a free leverage here. Suncor is not going to be below $20 US in January 2024. Like with my macro outlook, there is no way that was going to happen. So I bought these as kind of, okay, it's free leverage on my underlying. So I paid 15% premium again in October. The stock's up 36% and the option is up 83%. And as the share price goes up, the option just gets more and more torquey because it is now in the money, obviously. So, again, look for these strategies. Try and play options like they're equities. I keep harping on the same thing, but don't treat them like options. Treat them like equities. You're getting a leveraged equity. I have never looked at implied volatility. I have never looked at the gammas, and look at the macro on the oil. Find the stocks that are going to respond well in that macro, and find the options that give you the proper leverage on those equities with the minimal downside risk, and you will be laughing your way to the bank every single time. I think it's market cycles make people look like geniuses, but that's what I'm trying to say. You have to be convinced in the macro first, and then the equities are going to respond to that macro. And if you're convinced enough to buy those equities anyway, you can get all this leverage on the options if you play them properly and run your calculations, and kind of go from there. You don't have to buy options if in the money. Yeah, so I don't even hold options that are I don't even hold options till the expiration date, so it doesn't even really matter. Like, I just sell them on the market, and I find a lot of liquidity is there hidden. Again, if you want to sell them or buy them, the bid ask spread is totally wrong. It does not show you all the orders that are in there, and it doesn't show you the right volume. And don't ask me why that is. That's just how the markets are run these days. There's a lot of iceberg trading. There's a lot of hidden algo trading that once they see that bid, then they throw in their big volume sells, or however they're doing this these days. Yeah, so I'll leave it at that. Vermilion, absolutely amazing. Vermilion was one that I did my Saturday seminar on, and I talked about why I'm not in Vermilion, because I thought there's going to be a lot of selling pressure with the bag holders getting out, and the European 2022 and 2023 strip had not moved up, even though the spot price was moving up and the European gas crisis was in its early stages. And guess what happened? Then the weekend after, or the next week, they do this Coreb acquisition, get more exposure to European gas. And then the following week or week or 2 weeks, the 2022 and 2023 strips start moving up in a lot, 30-40% up. And I thought, okay, bang on, this is the time to buy Vermilion. It was kind of in the early stages of Omicron, so I got a good deal on it because the equities, people panicked a bit and they were selling these equities. So December 10th, I bought this about 2 weeks after Omicron first hit. Vermilion was about $11.38. I bought these way out of the money options, December 2022, $15. And I paid a 47% premium on them. So I had to overpay for these. But the stock is now up 73% in 3 months. And the option is up almost 300%. So I got a 4X. And again, if the stock keeps going up more and more, because I bought an out of the money option, I get a lot of torque on my option. It just keeps going up more and more and more percentage wise compared to how the equity moves. So 2 things here. One, I bought December 2022 because that's when the European gas situation will become very clear that going into the 2022 winter, they are not going to be in a good situation. That has got even worse with this Russian gas situation. So, I feel very, very bad for the European people suffering from energy poverty, poor political decisions, and too much virtue signaling, a very messy transition. But the market is the reality. You have to look at the markets as a fundamental being out of the emotional side of things. And I saw that this gas crisis was just going to get worse and worse and worse. They were shutting down their coal plants, they were shutting down their nuclear plants, and they even bombarded them so that they collapse their coal plants and nuclear plants. So you can't even restart them in the case of a emergency, which looks pretty stupid these days, doesn't it? So that's my first point. And my second point here is that I ran the numbers on this option a little differently. So what I did was I looked at my buying price, which was, I paid $1.76 for these options. And I said, look, I want a 10 bagger on these options. I want them to 10X. So the way I would get a 10X is if the $1.76 option went to $17.60, okay? By December 2022, for the option to be at $17.60, the share has to be at $17.60 plus the strike price. So 15 plus 1760, about 3260 is what I need on Vermilion by December 2022 for a 10X on my option. And that's how I ran the math. Vermilion was at 1138 back in December 10th. So I said, look, a 3X on Vermilion by next December, less than a 3X, gives me a 10X on my option. Very, very safe play. There is no way Vermilion was going to drop below 1138 with the European gas pricing how it was. They had hedged a bunch of it. The oil macro was looking great. So I got a free 3.5X torque on my underlying. And, I honestly think this could end up being a more than 10X, especially if they announce a dividend and a share buyback, which they easily could. They're generating more than $2 billion of cash flow at today's pricing, maybe 2.5. After hedging, unhedged is like more than $3 billion of cash flow. So, it just doesn't make any sense. And the hedges will again roll off. December 2022, the hedges roll off. People will start looking at 2023 cash flow metrics. And I think Vermilion could be at $50 by then. It's not out of the question, given how dire the European gas situation is. So, yeah. I won't talk about this too much. It's the same Vermilion December 2022 option, except I bought a $10 call. So more in the money. It still gives me the upside torque, but it's even safer. And maybe I played these things too safe, but it's better to play too safe with options, especially when you're already getting a 3 to 7X leverage. Why go for the 10X play and the 15X play if you have to take on a lot of downside associated with it? So again, run the numbers, run the calculations, and you will find very, very good deals there. Okay, so there's a question here. How do you determine if the options are worth buying and not over expensive? So you're right. The premiums have gone up a lot, like significantly higher. How do I know that they're over expensive? I run them through my calculator, right? The two that I have built, I run them through that and I say, okay, Vermilion today is $20. I still think Vermilion can be a $50 share in December, okay? So that's a 2.5X on the share. TD gives me the option to buy Vermilion on margin. So I can pay 50% margin and 50% equity. So if I buy Vermilion fully on margin, as in 50% margin, 50% my cash, and the stock goes up 2.5X, that gives me a 5X on the option or on the margined equity. So the equity gives me 2.5X, the margined equity gives me 5X. The option has to give me at least 8 to 10x for me to be worth taking that extra risk that comes with options. And you know what? I have not found any options in the last 6 weeks that give me more than a 6, maybe a 6.5x. Therefore, I haven't bought any options in the last 6 weeks. It's as simple as that. Compare the option to what you think the share price is going to be on expiry, and then compare the option potential to the share price potential and the margin share price potential, and there you go. That's basically all I do. I don't look at anything else. I don't spend hours and hours looking at volatilities and earnings releases and all this other stuff, because you don't need to. It's people that use those sorts of things are the day traders. They're the people who are playing one-day options, weekly options, monthly options. They need to look at those things because they make a big difference. But a lot of that conjecture and learnings, they don't need to be applied to long-dated options. They don't need to be applied to most of the in-the-money options. They don't really need to be applied to commodity trades where the macro is much more important and the equity itself is much more important. And people have just convoluted and complicated these things way too much for the actual information that we need to make the decision. So again, it's simple. For me, I have a target share price for the equity on the expiry date. I look at the premium that the options give me, and I compare them to the equity and the margin equity. And if they give me more reward compared to the risk that they come with, I buy them. Simple. Okay, and I think this is the last one. ARC Resources, September 2022, Canadian dollar 16 option. So I paid a 40% premium on this, 41%. I bought it in early January. I was not happy with the premium I had to pay on it, but I think a lot of people kind of beat me to the punch here. So I paid 40% premium, but I got a very cheap option that was quite out of the money. It was almost 35% out of the money when I bought it. So what does that mean? That means that the stock is up 31% and the option is up 129%. So you might be thinking, well, that's not really that great leverage for paying such a big premium. I only got 4x, but the real calculation comes in when you go back to how I calculated the Vermilion option. So I paid 86 cents for this option. If I want a 10 bagger, it needs to be at $8.6, right? Canadian, plus the strike price, $16. So 16 plus 8.6 is 24.6. Is where I need ARC Resources to be by September for me to get a 10x. It's $16 today, roughly. Anyone who holds ARC Resources who's on this call today, are you expecting it to be $24 by September? I bet most of you would say yes. You would say that, yeah, that's what I'm hoping for on my equity anyway. So if the share price goes up 50% from where it is today, from 16 to 24, my option goes from $1.98 to $8.60. So I get a more than a 4x on it from today. And let's say ARC Resources goes up even more. Let's say the ACO trade is looking good, the condensate trade is looking good, the NGLs are selling for a lot of price. Summer demand season kicks in, oil goes to 140. Things are looking really good. Let's say ARC goes to $32, right? So it doubled from here, right? If ARC goes to $32, which is a double from here, which is totally within the realm of possibility, I get a 20 bagger on my options. And it's as simple as that. When you buy out of the money options, you don't get the torque up front, but if the play pans out, you get so much torque on these options, and it is just insane the money you can rack up in short time frames. And I got till the 16th of September, which is lots of time to play the summer demand season, to play the pent up demand, to play the 2022 winter ACO storage, which is very low, to play the condensate trade, the NGL trade. I can play the Q1 results, the Q2 results. I get the share buyback, which is very aggressive. They've doubled the share buyback here since mid-February from 125,000 shares a day to 250,000. I get all these extra catalysts. and I don't even need them because the option is already more than doubled. And it's just all cherry, cherry on the cake. And yeah, that's my, that's the way I run this ship. And don't play YOLO plays. Don't play short dated options. Don't buy earning options, 3 days before earnings. Again, not my recommendation. That's just my strategy is what I'm trying to share here. And you know what? Yeah, they've all worked out, but they've worked out because you want to be very convinced in the macro. You want to buy proper equities that are actually going to re-rate, and you want to buy the right options according to that, and you will be very happy with the way the oil trade is playing out and is expected to play out here. There's a question here. What does open interest mean? So open interest refers to how many calls currently are out there. Like how many option contracts are already opened up, as in they're out there. So why that's important is because if there's not too many open interests out there, that tells you that people are not buying this option very much or selling them, as in writing them. Therefore, the liquidity will be a little bit lower than some of the ones with higher open interest. There's a question here. Do you think natural gas will go higher? I believe so, yes. Especially if this BC blueberry issue is not solved in Canada, you could see AECO strip at $5 or $6 this summer. Like that's not out of the question. The AECO inventories are sitting at basically decade lows. Demand has gone through the roof because of this coal to gas switching. There's this elephant in the room of LNG Canada coming online eventually in the next 2 to 3 years. So we need to prepare for that in a way, and that's pushing gas prices higher so that people drill more. It's just a supply demand dynamic on it. And okay, all oil and gas companies do not have options. Yeah, you're right. So not all of them have options. Only certain ones. The dual listed ones definitely have options. And then Baytex, Arc Resources, MEG are the Canadian ones that have options, but not too many else. I'm hoping they get started. The Baytex options are very new, so I think some other ones might be coming. Okay, there's a question here on how do you manage the risk on calls with the risk of a second half recession looming? So the name here is iPhone, so I don't know who you are, but please send me data in my DMs or my email of anything that shows you a recession coming in, as in not consumer sentiments, not what's going to happen if the Fed does this, but actual data. To me, the American consumer is in better shape than they ever have been. And I know there's people providing anecdotes of XYZ can't pay for fuel and XYZ can't pay for rent. I'm saying on the aggregate, the American consumer is in better shape than they've ever been, and that's fact. That's based on household debt to GDP. That's based on household debt payments as a function of their incomes. That's based on the tax receipts going into the US government. That's based on the unemployment rates and the job openings that are out there. People who want money can get money by switching to other jobs, by the people that want to spend money can spend money because they have such low debts to GDP. They have such low interest rate payments or interest payments already that it really doesn't matter if the Fed raises rates. In my opinion, I am not a macroeconomic guy, so I'm not going to make any claims. I just want to see data. I want to see hard data that I can interpret, that I can kind of make an analyze off and kind of get more understanding of whether a recession is coming, because right now I just don't see it. Especially this summer, there is no way there's going to be a recession coming in the US anyway, which is the biggest demand market. It's the most transparent market. It's the one we can see clearly. Anyways, a lot of emerging markets, I think, have a lot of levers they can pull with subsidies and tax, removing tax on gasoline, removing tax on diesel. In India, for example, 50% of the cost of gasoline is tax. So Do you think the Indian Prime Minister is going to let the economy get derailed coming out of this recession because they don't want to, coming out of the COVID crash, I should say, because they want tax receipts? No, they're going to reduce taxes. They're going to subsidize consumption, and they're going to have their economies firing on all cylinders, because this is a time that people are wanting to go out. People are wanting to buy things. They want to buy services. And for a government, they don't want to have inflation get out of control. They don't want to have people, not happy because they can't buy stuff. So keep that in mind. When you're talking about emerging markets, they have a lot of taxes on their petroleum products, especially. So there's a lot of juice left to squeeze on that before they can, before they need to destruct demand specifically. Where can I find a link for today's Petrotal Zoom? So I think Sohaib will share the link, or Alex Stahel, follow him on Twitter. He's kind of the guest of honor, so he will be sharing that. There's an off-topic question here on, do you have an opinion on Libya losing 330,000 barrels a day? So I've talked about this before, that we were in a supply-demand issue of 1.5 to 2 million barrels a day in December and January and February, with Omicron impacts still there in some countries, and with Ecuador online, with Iraq firing on all cylinders, with Libya firing on all cylinders, with Canadian production at record highs, with the US production relatively faring good, Saudi's pumping basically the max that they've pumped over the last 5 years for an extended period of time. So not the sudden spikes they had to 11 or 12 million barrels a day. Like they're almost at the max of what they've consistently pumped for like if you take a 6-month average. I've talked about this before. I think I had a Twitter post too, that Libya was going to go down at some point. Ecuador is going to go down again at some point because of their pipeline problems. Iraq is going to go down. And guess what we are today here? Iraq is down 500,000 barrels a day because of maintenance and a protest. Libya is down 330,000. Again, I bet you Ecuador goes down again in the next 3 months. 200 to 400,000 barrels a day goes down there. So you know what? It's just more fire for the bull thesis. We need everything in the world at full capacity, and we still don't meet the demand we have today, if you take into account that Russian oil is down. So what does that tell you? And I have a macro session coming up 2 Saturdays from yesterday, where unfortunately, I think the last one was 3 hours. I think this one's going to be 4 hours. But you know what? There's so much to talk about on the macro, and so many points to make, so much excellent data that I've been looking at. And I'll talk more about the Libya situation there, and why that oil will never be at full capacity, and why you will probably see more downside than to see it at full capacity for any extended period of time. It says Grand Tierra also has dual listed options. Yeah. Thanks for the reminder, because I missed out on that big time. And I think I should have bought in, and I hope, Vic, you got into them, because those were selling for such amazing prices, some of which I think could end up being 50 beggars if the oil price keeps going up. Some of the 2023 January and 2024 Januaries, if you bought them at 15 cents or 10 cents, I think like they could be 50 beggars. Yeah, like I said. My options are all in the US market except ARC Resources, because the US market on the dual listed stocks just offer way better liquidity. The bid-ask spreads are tighter. So just a better place to be. Canadian options just don't have the right liquidity market for them in oil and gas. There's a question on potash companies. So I don't know much about the potash market, so I can't speak to it myself, but I'm working very hard to get 2 CEOs of potash companies on Twitter Spaces and share from their perspective the supply-demand issue that we're seeing the fertilizer issue that's going to come up, and why a lot of potash is going to be very, very productive down the road, and why the new potash technologies that are out there are going to make the old mines obsolete. So just like SAGD came in and they made the old oil sands mining almost obsolete in a way, this new technology of potash mining, not mining, potash recovery is going to be so much more economic, so much more ESG friendly, that it's going to take over. And I've invested in a private equity company that has a technology they're working on that's even better than the SAGD for potash. So just like SAGD came out in the oil sands, and then MEG Energy brought out the solvent injection, etc. This company is kind of at the forefront of these sorts of technologies. And yeah, I have a private equity position, full disclosure. I trust the management team, etc. But I'll have them on Twitter Spaces directly so they can speak their side of the story, because I don't want to sell anything here. We're running very short on time here, so I will just get to these last questions. Are there any services or data sources you look for oil and gas supply and demand? I spend probably 60 to 70 hours a week on oil and gas supply, demand, macro, in-depth equity research, meeting management teams, running calculations, going through certain services that I've subscribed to. So there is no quick and dirty answer for you. I have a checklist coming out in the next month or so. I will post it on my website, where I will give you all the links to things that I watch and see. But the unfortunate reality is that a lot of stuff is behind paywalls, it's behind subscriptions. So a lot of stuff I share in my macro outlooks, which are again every 4 weeks on Saturdays. I share almost everything that I'm seeing on there, and those are probably the best way to get into them. Unless again, you want to be spending hours and hours and hours scraping data, talking to people in Vietnam and talking to people in India and talking to people in some small town in Southeast Saskatchewan, etc. There just is no easy way to get all this data. A lot of it is not transparent, like Chinese data, Saudi Arabian data. You're doing a lot of guesswork. You're asking experts in the sector to kind of give you their best interpretation, etc. So can you speak to the Saturn oil warrants? Okay, so it's a $3.20 strike. You need 20 of them to break even, to go and buy one share. I see Saturn as a $9 to $10 share price by June 2023, barring further dilution. So keep that in mind. They are looking for deals. They might buy other properties, which could cause dilution. But today I see it as a $9 to $10 play by June of 2023, which is the expiration. I see about a 7x on my, if you buy them at about 4.5 cents / 4 cents, it's about a 7x-ish roughly on there. Supply data for Kepler is affordable for retail. Yeah, I don't want to talk to my sources directly, but I have certain agreements made with data sources where I tell them, I give them certain information that I think is important. I help them build their service, and in exchange, they're giving me some data for free. So I think I have better data than Kepler, but I don't want to speak to these contracts directly. Okay, well, it's 2 o'clock, so I'm going to end it here. Thank you everyone for attending. Again, I hope you found this useful. I can have a spaces on individual technologies and catalysts that I see on companies like Surge, Spartan Delta. I've talked about them in my kind of valuation sessions a bit, but I'm more than happy to host a spaces or one of these Zoom calls on the catalysts I see for oil and gas companies, oil sands, condensates, helium, EV metals, and potash. Those are the plays I'm going to get into after the oil trade kind of doesn't offer me the same risk reward. And that's where I'm looking at the private equity space. So I'm more than happy to do that. But again, Thank you everyone for attending. I hope you got a lot out of this, and please feel free to reach out to me. I know on my website I have a intro to kind of oil seminar next week, but I don't think I'll have time to get that ready in time. So that will be postponed, unfortunately. But yeah, thanks again. And I look forward to seeing you all in the Petrotal space here, which I see has begun. So see you all there. And thanks again. Have a great rest of your Sunday and a great rest of your week.